So number 197, long-term rentals and short-term rentals, the real estate rental barbell. It's 39.6 Facebook and YouTube live finance show. So it teaches high earners like yourselves how to make your money work for you so you don't have to work for your money. Talk general investing, taxes, real estate, syndications, Airbnb, paying for college, paying for childcare, and even the car you drive. It's been a minute, as they say. I'm on vacation now for a week. Hoping to put the daily show back on. Winter officially came in to Texas, as much as winter comes into Texas. I think we were in the 40s yesterday, although we were like in the 70s the other night. Went on a carriage ride 3 nights ago, and it was almost 70 degrees to see the Christmas lights. So that was nice, but it's chilly now and ready for Christmas. We sent out, with the help of my little elves, I think a couple hundred Christmas cards yesterday. The ones that we were more confident about addresses. We still have a bunch of others. I think we ordered almost 500. We might have ordered 500 Christmas cards this year. So, if you are on our Christmas card list, hopefully you'll get it before Christmas. All right. So, today we are going to talk about long-term rentals and short-term rentals, the real estate rental barbell strategy. I've talked about this actually a lot with people more one-on-one. Haven't done an episode on this, so thought that I would put one together because I talk about this a lot, and I see a lot of people getting into short-term rentals, which is a whole new thing for a lot of people investing in passive real estate or semi-passive real estate or very active real estate, depending how you run it. But it's very interesting because traditionally a lot of people, buy single family houses. That's how they get into the real estate rental game, and they use them as long-term rentals. That strategy can be very effective for a lot of people. As your income becomes higher and your time becomes less, and you really need a more fully passive approach, it's very hard to generate positive cash flow on single family rentals for a lot of people in a lot of places. It's just competitive because prices have gone up a lot. Okay. And I often refer to not just cash on cash return, but your time adjusted cash on cash return. So once you subtract the value of your time you put into managing a long term rental, even with a property manager, you still have things to do. Once you put a value on that time and subtract that from your actual income, it's very hard to be cash flow positive for high earners. Okay, now short-term rentals have changed the game a lot. Short-term rentals can certainly be very strongly positive cash flow. Okay, so this is one thing that I do really like about them. I do cringe a lot when I see people buying long-term rentals at prices where I don't see how they're going to have any positive cash flow at all, and likely are going to be cash flow negative just because they want to invest in real estate. I don't think that's the right way to go about it because I think you're setting yourself up for failure. But short-term rentals definitely have a lot of possibility of very high cash flow. Your rental rates in short-term rentals can be 3 times what they would be as long-term. Our one long our one short-term rental, which we run as a mid-term rental, has been renting out at 18,000 a month right now, and it's been rented at that price since August, I think, to just one tenant. So this is like dream situation, right? So you have like the hands offness of a long-term rental, but the cash flow of a short-term rental, no turnovers. This is like amazing. We're living the dream right now, at least on this one property. But short-term rentals in general can be very strongly cash flow positive, but they do tend to require more time, effort, stress, with turnovers and managing everything that goes along with a short-term rental. Now, you can still have them being like completely passive. You could buy a vacation rental somewhere where somebody else is 100% managing it, and they can take like often like 30% for that, and then it can be hard to be profitable. But one of the big benefits of short-term rentals is if you are actually actively managing them. Okay, and again, for a lot of high-income professionals, it doesn't make sense to really actively manage your properties, especially long-term rentals. But on short-term rentals is different. It can make a lot of sense to do some active management as a short-term rental because you don't have to have real estate professional status in order to qualify to have real estate related losses be active losses instead of passive losses, which is gigantic. Okay, so um, there are other episodes on this, but I mean, if you put in like 100 hours into a short-term rental, actively managing it yourself and putting in more hours than anybody else, there's a laundry list of requirements. But if that property has been managed as and run as a short-term rental, like average length of stay of 7 days or less than 7 days, I think to be safe, then those losses can be active losses for that year, and they're not subject to the passive activity loss limitations, which means you could be making $1 million a year and still take all those losses on your real estate assets with bonus depreciation, the ones that are short-term rentals that you're participating in. But that property, those losses can go on your W-2 as a negative number onto your 1040. Sorry, not W-2, onto your 1040, and effectively decrease your total adjusted gross income, thereby decreasing your W-2 income or 1099 income from your day job. Okay, so short-term rentals are fantastic. They have incredible tax benefits, more so than long-term rentals, but both of them are very, at least, tax efficient. Okay, but short-term rentals allow you to take those active losses, which is fantastic. They also allow you to cash flow quite positively. Okay, and when I look at a time adjusted cash on cash return for a high earner, you definitely can still be cash flow quite positive with a short-term rental, because let's pretend you have one property that is cash flow positive by $10,000 a month. And let's say it takes 10 hours of your time per month. Okay. Then if the value of your time is, let's say, $200 an hour times 10 hours of used time, that's $2,000 of your own time value that you've put into it. You're still cash flow positive $8,000. Okay. Now, if you value your time at $1,000 an hour, which is not unreasonable for a lot of people, then you're cash flow neutral. Okay. But basically, you got yourself a job where you can make $1,000 an hour for 10 hours. Now, um, so it's a lot easier to be cash flow positive on a time adjusted basis on a short term rental that you're actively managing, especially if you're going to be able to take those losses from that property to offset your very high income from your other job at a 37% federal tax rate plus a state tax rate if you have one. So um, that side can make a lot of sense. Now, we invest both ways. We have at least one short term rental. We might end up having more this upcoming year as a tenant moves out of a long term rental. But we also have, so we have one short term rental, maybe two. And then we also have our long term rentals. But our long-term rentals are really going to be more on the very, very passive side. Okay, so we have syndications in apartments because when you're buying those deals, you're buying them not at the same price that people are buying them as single-family owners of houses. So you can still get cash flow positive deals. I look at deals that cash flow at least 6% in general on an annualized basis, preferably closer to 7. 8 is fantastic, but also with expected growth. Okay, so on the syndication side, on the long-term rental side, we pretty much exclusively have, actually, yeah, we exclusively have syndications. And so syndications are fantastic because they are basically time free. So on a time adjusted cash on cash return basis, because there's no time spent on managing the asset or really doing anything, just filing your tax return once a year from a K-1, and initially signing the documents and wiring the money, on a time-adjusted basis, the cash-on-cash return is still positive, right? Now, long-term rentals are also fantastic in general just because they make for a very stable long-term play. That cash flow is relatively stable over time. Appreciation, you can force appreciation. You can drive up net profit, drive up income, decrease expenses, and you can force appreciation over time. And when you're investing in commercial real estate assets like apartments, then you, by increasing that value, you effectively increase, because I guess multiplied by a multiple, you can increase the value substantially, and just do this irrespective of the market. Now, the market can work against your favor if the prices go down, but still, because you can force the appreciation up, you can be much more in control of the valuation of that property. Okay. And so you can have positive time adjusted cash flow and long term growth, all very tax efficiently. Okay. And so that makes up a large percentage of our portfolio. And then we have the short term rental side, where we don't have nearly as many assets, but they're very strongly cash flow positive. Okay, I can't really force appreciation on a single family property in the same way because it's not valued as a business. Now, fortunately, it's appreciated a lot, like most all single family houses have in the past year, but that's market based. That's not us doing that. So we're not in control of that. Okay, the same way, if the market loses value, I don't have control over that either. Okay, so you have a lot less forced appreciation on single family type properties, which we would run as short-term rentals. Okay, so you have short-term rental, high cash flow on a time adjusted basis, excellent tax benefits. Okay, you can still get some appreciation, but not necessarily as forced. Okay, even if you put time into it, your time can still be worth that time and effort. On the long-term rental side, I take all the time completely out of the equation so that I'm still time adjusted cash on cash positive with sustainable income over time and strong forced appreciation over time. Now, short-term rentals can always potentially dry up. Okay? There's always potential legislature that could make you shut that business down for an individual property. My general approach is to buy short-term rental properties that would still be able to function as a long-term rental. Um, and that way you always have an exit strategy. Now, you could also buy something that's very much undervalued, put some money into it, and effectively have an exit strategy of selling it if you're able to increase the value that way. But I think it's safer to have something that works as a longer term rental. And so that's our general approach. So why is it called a barbell? This is a term used in finance in a number of ways. Often there's a term, a bond barbell, where you have short-term bonds and long-term bonds because they behave differently based on interest rates and other market forces. And sometimes long-term bonds will be much more higher performing, and sometimes short-term bonds can, relatively speaking. And so, and short-term bonds often are on the safer side, and long-term bonds will be on the more riskier side. Some people made just an absolute ton of money with long-term bonds in the not too distant past, the past couple of years, as interest rates have just plummeted, and the value of those long-term bonds have gone through the roof. It's a ton. There's a lot of ways to make money in bonds. Bonds are not just based on the interest rate, the cash flow part. Appreciation is part of the total return on a bond. Okay. Now, so short-term bond versus long-term bond combined make a bond barbell. Short-term rental, long-term rental combined. Yes, there's your real estate rental barbell. All right. Thanks for joining me today on episode 197. I'll try to do this every day this week. Again, 39.6 Facebook Live and YouTube Live Finance Show. This show teaches high earners like yourselves how to make your money work for you so you don't have to work for your money. PSA for today. Maybe, you know how Bob Barker always said, don't forget to get your, what did he say? Get your pet spayed or neutered. Keep your kids rear facing in the car as long as possible, at least age 4. Thanks a lot. Have a good Sunday.